Happy New Year, everyone. Let's take a look at 2021 performance for the multi-strategy portfolio that we teach. We will first look at the market state based on the S&P 500 performance. Then we will look at the individual strategies performance given this market backdrop. Finally, we will look at how the various strategies work together to deliver the overall portfolio performance. The market state for 2021 can be broadly classified as a smooth upward trending market, with each minor correction quickly corrected for the S&P 500 to make new highs. This kind of market state is generally friendly for pure long equity strategies and strategies that short volatility. Strategies that include other asset classes like bonds and commodities typically tends to lag behind S&P 500, as these asset classes tend to underperform stocks. Our two-asset risk parity model maintained a generally high allocation of between 70 to 80% to US Treasuries throughout 2021. US Treasuries sold off in Q1 and stayed more or less flat throughout the rest of the year. As a result, even though the risk parity model ended the year in positive territory, it lagged the S&P 500 by quite a bit due to the negative performance in US Treasuries. Our trend model started the year with a leverage exposure to stocks and maintained this level of exposure throughout the first 3 quarters. It began to trim stocks in Q4, but exposure still remained above 100%. Therefore, as expected, our trend model outperformed DIA, which is the ETF tracking the Dow Jones Industrial Average. Moving on to our volatility trading strategy, the VIX was on a general downtrend despite intermittent spikes which quickly died down. The volatility risk premium model maintained a short volatility positioning through most of the year and so benefited from this downward drift in VIX. However, a brief spike in VIX towards the end of November and a subsequent whipsaw action in December erased some of the gains made. In the end, our volatility trading strategy underperformed S&P 500 for 2021. Sector rotation was partly dragged down in Q1 by a slight allocation to long-duration US Treasuries, and the lower volatility sectors such as staples and healthcare trailed the hot sectors such as tech, which are heavily weighted in S&P 500. So it underperformed the index in the first half. Now, for the second half, the model allocated quite a fair bit to long-duration US Treasuries, which dragged down performance. As a result, sector rotation lagged S&P 500 for the full year. At the overall portfolio level, our multi-strategy approach generally moved in line with the S&P 500, although lagging behind slightly for the first half of 2021. Moving into the second half, the performance gap widened due to a heavier allocation to long-duration US Treasuries and a poor performance in volatility trading in November and December. In summary, it was an exceptionally good year for the S&P 500 as it was up almost 27%. All our strategies were positive, but the outstanding performer was our trend-following strategy, which is to be expected since it is equity-focused. Risk parity and sector rotation were dragged down by US Treasuries, while volatility risk premium underperformed towards the end of the year. All in, the multi-strategy approach delivered an overall performance of 15.2% for 2021. This kind of performance is what we would expect in a strong bullish year like 2021. Okay, that's all for this year's update. Thanks for watching.